So it's been a while since I last walked through my full portfolio on camera, and a lot has changed, not just in the market, but in how I'm thinking about some of these positions. A few of my biggest bets have played out almost exactly the way I expected. Others have forced me to rethink some assumptions, and I've made a few new moves that I haven't talked about publicly yet. So today I want to do something a little different. Instead of just showing you a list of stocks to buy, I want to take you through my actual portfolio. The wins, the losses, the ones I'm holding, the ones I'm adding to, and explain exactly why. Because I think watching someone update their thinking in real time is way more valuable than just watching someone tell you what to buy. My background, if you're new here, I'm a software engineer and solution architect. That's my circle of competence. I invest in what I understand. And I balance the volatility of my tech-heavy portfolio by putting 15% of my income into passive ETFs that just track the broader market. That part hasn't changed. What has changed is how I'm sizing some of these positions, and why. Let's get into it. Okay, let me start with a stock I talked about last time that I said I was considering, ASML. Quick reminder of why this company matters. ASML makes the machines that make the chips, not the chips themselves. The lithography machines that use laser light to literally etch circuit designs onto silicon wafers. Their biggest customer is TSMC, which manufactures chips for NVIDIA and AMD. So if you believe in the AI boom, ASML is the ultimate picks and shovels play. No ASML machines, no NVIDIA chips. It's that simple. Last time I talked about this stock, it was up over 100% since 2025. Since then, growth has cooled slightly. And honestly, that's made it more interesting to me, not less. Here's the thing about ASML. It's not a speculative bet. Their financial health score is extremely high on standard metrics. Revenue has grown consistently, gross profits are growing, there's no real bankruptcy risk. The fundamentals are genuinely strong. The reason the stock has slowed is their newest machine, a roughly $400 million high NA-EUV lithography tool, and the question of whether TSMC will pay that price. That's a real overhang. But here's my updated take. Intel has already installed one, and that's significant. When Intel is ahead of TSMC on hardware adoption, it usually means TSMC follows. They can't afford not to if they want to stay the world's best chip manufacturer. So in my view, ASML's short-term uncertainty is priced in, but their long-term position as the only company on Earth that can make these machines is not going away. This is still a 5 to 10 year hold thesis for me. I did open a position since the last video. Small starter position. I'll be adding over time. Okay. So last video, I said Celestica was on the riskier, higher upside end of my portfolio, and that has played out. The stock is up over 3,000% since Seeking Alpha first highlighted it. It's sitting near a $50 billion market cap now, and the question everyone is asking is there anything left here, or did we miss it? My honest answer? It depends entirely on whether you think the AI data center build-out is still in the early innings. Let me explain what Celestica actually does, because I think people still underestimate how central they are. If NVIDIA GPUs are the neurons of an AI system, Celestica provides the rest of the infrastructure, the storage, the compute interconnects, the networking switches that allow all those GPUs to talk to each other at the speeds AI requires. You cannot run a hyperscale AI data center without companies like Celestica. And right now, there are only a handful of companies that can do this at the quality level the big cloud providers demand. Since I last covered this stock, they announced a major collaboration with AMD for something called the Helios Rack AI platform. This is essentially a pre-built, optimized AI rack that pairs AMD compute with Celestica's networking switch technology. Why does that matter? Because one of the real bottlenecks in AI infrastructure right now isn't the chips, it's deployment. Getting the hardware set up in a way that actually performs at scale. Celestica and AMD are essentially selling a solved problem. The risk remains the same as before. This is a high-growth stock priced for continued high growth. If AI spending decelerates, this stock takes a big hit. But if you believe, as I do, that we're still in the first or second inning of AI infrastructure spending, the growth runway here is substantial. $700 billion in AI tech spending this year. That money is going somewhere. Celestica is one of the direct recipients. I still hold this one. Still a growth play. Still higher risk than anything else in my portfolio. But I'm not selling. Let me talk about Microsoft, because I think this is one of the most misunderstood stocks in big tech right now. The narrative around Microsoft in 2026 has been mostly negative. Copilot isn't living up to the hype. The consumer products are getting bloated with ads. There's even this meme going around that this is the year of the Linux desktop because people are just fed up. And here's my take. All of that is probably true, and none of it matters. Here's why. Microsoft's consumer business, the Windows stuff, the personal computing stuff, that's only about $14 billion of revenue. That's not where the value is. Where the value is, Microsoft Azure, cloud services, B2B, and Azure grew revenue 39% year over year on a company that already makes over $100 billion a year. That number is remarkable. Now here's the valuation angle that I think the market is missing. Microsoft's PE ratio is sitting around 26.5. Google is at 31. Apple is at 34. Meta is at 28. Microsoft is the cheapest of the major tech companies right now, despite growing its cloud business faster than most of them. If Microsoft's valuation just matched Google's, that's a 17% price increase from here, without a single additional dollar of earnings growth. But there are also two longer-term catalysts I want to flag. First, AI. Look, Copilot as a product is rough. I use it. I don't love it. But there's been a leadership shift at Microsoft where their AI chief is now focused less on shipping consumer products and more on building foundational AI models. That's a slower burn, but it's the right focus. The best AI products tend to come from the best underlying models. Microsoft is working on the foundation now. Second, quantum. Microsoft unveiled the Majorana 1 chip, a quantum chip using a genuinely novel architecture. They're claiming it can solve industrial-scale problems in years, not decades. I'm not betting on quantum paying off in the next 2 years, but in the 10-year frame, this could be significant. I hold Microsoft. I've been adding. The bad press is creating a buying opportunity in what I think is actually the most reasonably valued of the major tech giants. Let's talk about Samsung, and specifically, why I think the high bandwidth memory market is one of the most overlooked investment angles in AI right now. Everyone talks about NVIDIA. Everyone talks about the software layer. Very few people talk about memory. Here's the issue. You can have the world's most powerful GPU, but if you can't feed it data fast enough, performance hits a ceiling. High bandwidth memory, HBM, solves that. It sits physically close to the GPU and transfers data at extreme speeds. And right now, demand for HBM is completely outpacing supply. Samsung just launched their HBM4 product and they're already raising prices because demand is that high. They've signed a deal with NVIDIA to supply HBM4 for the Vera Rubin chip, NVIDIA's next-generation flagship. That's not a small deal. That's the supply agreement for what will likely be the most sought-after AI chip on the planet. Here's what makes this an almost structural investment case. The HBM market is an oligopoly. There are basically 3 players: Samsung, SK Hynix, and Micron. That's it. Fewer competitors mean more pricing power. And right now, the buyers, Amazon, Alphabet, Meta, Microsoft, are each spending $100 to $200 billion on AI infrastructure this year. They need memory. They will pay. Samsung's profits tripled in the most recent quarter. The HBM market is expected to grow at roughly 27% compounded annually for the next 5 years. Now, the risks. Samsung has exposure to both US and Chinese markets, which means tariff risk and geopolitical risk is real. And buying the stock isn't straightforward if you're in the US. Samsung is listed in Korea, so you either need access to a UK broker or you buy through an ETF. 2 ETFs worth knowing. EMQ gives you broad Asian tech exposure with significant Samsung weight. EWI, the iShares MSCI South Korea ETF, gives you roughly 23% Samsung weighting. That's how I'm holding this one. IBM is a stock I openly said I was down on when I first bought it. I said it was a long-term hold and I meant it. I'm still down on this position. And I'm still holding. Here's why I haven't sold. In AI, IBM is behind. Watson was impressive in 2011. OpenAI, Google, Anthropic, they've all lapped IBM. That's a real risk I acknowledge. But in quantum, IBM has a legitimate 5-year head start on almost everyone. They put quantum computers on the cloud back in 2019. They built Qiskit, the world's most popular quantum development SDK, which now has over 600,000 developers using it. When someone learns quantum programming, they almost always learn it through Qiskit first. That's a massive moat. Their newest system, Quantum System 2, isn't a science experiment anymore. It's modular, deployable, and connects directly to IBM's cloud infrastructure. The Cleveland Clinic has had an IBM quantum system deployed on site since 2023. That's real-world usage, not lab demos. And here's the investment angle that ties it together. IBM's business model is cloud plus consulting. You sell your cloud customers into consulting. You sell your consulting customers onto IBM's cloud. Quantum fits into that ecosystem naturally. A pharmaceutical company using quantum to model drug interactions doesn't need to run their own cryogenic quantum computer in the basement. They just log into IBM's cloud. IBM has announced a $150 billion investment in quantum over the next 5 years. The R&D pipeline is not slowing down. I own 30 shares, still down about 13%. Still holding. This is a 7 to 10 year thesis. Cloudflare is my biggest position by return. I own 172 shares, up around 200%, roughly $36,000 at time of recording. And even at this valuation, I haven't sold a single share. Let me tell you why. Cloudflare's job, at its core, is to make the internet work better and more securely. They don't care whether the traffic they're processing is human or AI. They get paid either way. And as AI agents start to replace human web users in enormous numbers, Cloudflare becomes more essential, not less. Their Q4 revenue came in at $614 million, up 34% year over year. The CEO specifically called out the shift to AI and agents as a fundamental replatforming of the internet that is driving demand across their services. Here's how I think about it. Every wave of internet evolution, from dial-up to broadband, from broadband to mobile, from mobile to cloud, Cloudflare has benefited. AI is just the next wave, and they're already positioning for it. They've expanded their agent cloud specifically to support the infrastructure that AI agents need to run on the internet safely and at scale. There's also the quantum security angle. Q-Day, the day when quantum computers can break public key cryptography, is a real threat that organizations like the NSA are taking seriously. Google thinks it could come as soon as 2030. IBM is saying 2029 for high-value targets. Cloudflare has been preparing for this. All websites on their platform are already quantum resistant as of 2022. 65% of human traffic is quantum encrypted. They're targeting full post-quantum security by 2029. That's not marketing. That's infrastructure investment that will matter when Q-Day actually arrives. What would make me sell? 3 things. If revenue growth drops substantially, if their losses start increasing again as a percentage rather than declining, or if their CEO leaves, because I genuinely think his leadership is a core part of what makes this company special. None of those things have happened. I'm holding. Okay. The newest position I've been building most aggressively. Constellation Energy. Here's the thesis in plain language. AI data centers consume enormous amounts of electricity. That percentage is only going up. Some projections have data centers consuming over 10% of all U.S. electricity by 2030. The companies running those data centers, Microsoft, Meta, Amazon, Google, have made public commitments to use clean energy. And right now, the only company in the U.S. that can supply clean energy at that scale is Constellation Energy. They signed a 20-year nuclear energy deal with Meta for a facility in Illinois. Microsoft reactivated 3 Mile Island and paid a premium for that power. Nuclear is the only baseload clean energy source that can actually meet the kind of continuous massive demand that AI data centers require. Now, here's the contrarian part of this thesis. Public fear of nuclear is not based on current data. The safest forms of electricity generation are solar first, nuclear second. Nuclear is safer than wind, and orders of magnitude safer than natural gas, oil, or coal, even accounting for historical disasters like Chernobyl and Fukushima, which used much older technology. Modern reactors are in a completely different category. There's a disconnect between public perception and reality. That disconnect creates a pricing opportunity for investors who follow the data. And then there's the short-term play. Constellation recently acquired Calpine, one of the largest natural gas companies in the U.S. This gives them a natural gas bridge while nuclear capacity comes online. So they capture revenue now from gas, and larger margins later from nuclear. I bought 30 shares. I'm planning to add, this is my highest conviction new position. So that's my full updated portfolio. These are the 7 positions I'm tracking most closely right now. ASML, Celestica, Microsoft, Samsung, IBM, Cloudflare, and Constellation Energy. Each one sits at a different point on the risk curve. IBM and Microsoft are my stability plays. Cloudflare and Constellation are my highest conviction long-term holds. Celestica is the moonshot. Samsung is my infrastructure bet. ASML is the monopoly I finally started buying. One important reminder, I invest with a minimum 5-year horizon. Most of these are 10-year bets. If you're looking for short-term trades, this is not that. The only stocks I'd flag as having near-term catalysts are Microsoft on valuation compression and Constellation on energy contracts. If you want daily updates on these positions and any trades I'm making, I share everything on Instagram. Handle is in the description. And if you found this useful, let me know in the comments which of these stocks you're most interested in, and I'll go deeper on it in the next video. Thanks for watching.